In February of 2024, the average home equity in the United States was $299,000. But most homeowners don't realize all the options that are available to them to access this money. I'm Terrell Higgins, a real estate and personal finance nerd, and today we're going to be getting into 5 different ways you can access the equity in your home. And the last 2, most people have never even heard of. We're going to explain when is a good time to access that money and when you should absolutely avoid accessing that money. And I'm going to share my personal experiences with using the equity in my home. Let's get into it. So the first way is a cash-out refinance. So a cash-out refinance replaces your existing mortgage with a new mortgage, and it pays you out a lump sum of money in your equity. And generally, they will only give you about 70 to 80% of the equity that is available in your home. But since you are refinancing into a completely new mortgage, these generally have the most favorable terms and the lowest interest rates of all the different equity strategies that I'm going to highlight in this video. One thing to keep in mind with cash out refinances is that there will be transaction costs associated with closing that new loan. Those transaction costs are going to be between 2 to 5% of the value that you're intending to borrow. The next way I want to talk about is a home equity loan. So it is a lump sum payment, very similar to a cash out refinance, but the biggest difference is that it is an additional payment on top of your existing mortgage. It is considered a second position loan. So what that means is that if the lender forecloses on your house, your primary lender, the mortgage provider, is going to get paid first, and then whoever that secondary lender is who's providing that home equity loan will get paid out second. And since it's in a less favorable position in the capital stack on your home, they generally have higher interest rates than if you were going to do a cash out refi. And it's a very similar situation where you can only access about 70 to 80% of the equity that is available in your home. Some of the biggest drivers on how much of the equity the lender is going to be willing to give you are going to be your debt to income ratio and the loan to value ratio. So if you have a more favorable debt to income ratio, they'll actually give you access to a higher percentage of the equity in your home. And if you can still maintain a favorable loan to value ratio, they're willing to give you more money as well. So let's talk about HELOCs. So HELOCs are kind of like a credit card on the equity in your home. So unlike a cash out refinance or a home equity loan, a HELOC is not a large lump sum payment. It is a line of credit that you can access when you want to use it. So with a HELOC, the rates tend to vary, where with the home equity loan and the cash out refi, they were locking you in at a fixed rate. These HELOCs, there are fixed rate products and there are variable rate products, and there are hybrid products where depending on the duration of time on the HELOC, it will change from a fixed to a variable. So if you are exploring a HELOC product, you want to look at all the options that are available to you. And generally, these HELOCs have much higher interest rates than you would get on a home equity loan or a cash out refi, but they give you more flexibility of being able to use that money and then pay it back, use the money again, and then pay it back again. So if you are in need of money for a short duration, so say you're doing like a fix and flip, for example, you could finance the fix and flip on this HELOC, complete the fix and flip, sell the home, and then repay your HELOC and take it to the next home you intend to fix and flip, and keep repeating, putting money on the HELOC and taking money off the HELOC to finance your deals.
More money, more money, more money.
And HELOCs are a good way to create an emergency fund for yourself because you don't actually have to access that money right away. It's just available if you actually need to use it. One thing you do have to consider is that there are maintenance costs for keeping this line of credit open. They call these membership costs, and a lot of times it can be as low as $5, but you can see as high as $250 per year to keep this line of credit open, which is really not that bad considering that most people have almost $300,000 of equity in their home. Having access to 80% of that for $250 or $5 is a pretty good bargain. So this is where the options get interesting. So a reverse mortgage is only available to people who are 62 years old or older. And your home either needs to be paid off or you need to be capable of paying off that home at the time that you're closing on this reverse mortgage. So with the reverse mortgage, the lender is paying you back fixed amounts of your equity in your house every month. So it's a good way to supplement your income in retirement. This lender will continue to make these reverse mortgage payments to you in retirement until one of three scenarios plays out. You've exhausted all the equity in your home, in which case they will stop paying you that reverse mortgage. You pass away, in which case your estate has to address paying back that reverse mortgage through either selling the house or using some other assets from your estate to pay off that reverse mortgage, or you actually sell the home in retirement. If one of those three scenarios plays out, then the reverse mortgage will stop paying out and the contract will end. So these reverse mortgages can be a strategic tool in your retirement planning, but you really want to sit down with a retirement planner or a retirement professional to make sure it is the best strategy for you in retirement. So the last way to access the equity in your home is actually a fairly new way to access the equity. It's called a shared equity agreement. So essentially, an investor is paying you money to have a future stake in the equity in your house. So let's do an example here. So if you have a $600,000 house and an investor pays you $100,000 to have a 25% stake in your home, and then after 10 years, which is the normal length of time for one of these shared equity agreements, your home appreciated to $1 million. So that's a $400,000 increase. That investor is going to get his initial $100,000, and he's also going to get 25% of the equity in your house that it is increased. So 25% of that $400,000. So that investor is going to be owed $200,000. So you might be wondering, why would anyone do this? This seems like the most expensive option for accessing the equity in your home. And the main reason someone would consider one of these shared equity agreements is because you don't actually have to make monthly payments in a shared equity agreement. The only time they get paid out is at the end of the term. So if you have a 10, 20, or 30-year shared equity agreement timeline, you don't actually make payments to them until you either sell the property or the term is complete. And if your property actually lost value in that 10, 20, or 30 years somehow, you don't owe them any more than what they initially gave you. So if they gave you $100,000, at the end of that 10 years, you just need to give them back their $100,000. And if your house depreciated, it actually lowers the amount that you have to give them back. There's going to be a slight deduction to the amount you owe them based on that depreciation. So if you are cash strapped, these shared equity agreements could be a very good way to alleviate some of the cash flow constraints that you might have in your monthly budget. The biggest drawback is that when the term of the shared equity agreement is complete, you're actually going to have to pay the investor back. So you either need to have that cash on hand, whatever they gave you, plus the additional equity that has been created, or you need to take out some sort of loan, either a cash out refi or a home equity line of credit, or dip into your savings to actually pay back this loan. So you are deferring these payments into the future, but it is a big problem that future you is going to have to sort out. Either you're going to have to sell the house or come up with some other financing to end this shared equity agreement.
Don't do that.
So why shouldn't you access the equity in your home? So if you are struggling to make the current payments on your house and then you refinance into even higher payments into your home, or create a second position on your home through a home equity loan, then you're putting yourself at risk of further financial instability. You could get your house foreclosed on, or it can force you to the brink of declaring bankruptcy. And that is not where you want to be. Another reason to not access the equity in your home is because it puts you at risk of market fluctuation. You could access the equity in your home and then the home values could go down. And if they go down, you'll be underwater on your loan on the home, which means you won't be able to sell the home for profit. You'll actually be taking a loss if you try to get out of the home, and it's going to mean that you're stuck with the home until the housing market recovers. A lot of people found themselves in this situation when they purchased their homes in 2008. They were waiting several years before they had an opportunity to sell. The other thing is, when you access these funds, it kind of resets the clock for you paying off your home. So if you want a paid off home in retirement to keep your month-to-month costs low, you're going to be extending that timeline that you have available to you to actually retire. It may offset your timeline by 5, 10, or even 20 years, depending on when you are accessing the equity in your house. So you really have to think about how accessing the equity in your house is going to impact your future plans, especially retirement. Another thing to consider when accessing the equity in your house is the impact on your credit score. So when you open new lines of credit, your overall credit score is going to take a hit, and your credit utilization number is also going to go up. So it's going to be more difficult to get loans for other things. So if you want to buy a new car, or you're considering buying a vacation home, accessing this equity could set you back, where you might have to wait until you're in a more favorable position, or the loan to value ratio is a lower amount before you can get the type financing that you want. When you access this money, there's the potential that you misuse these funds. you should not be utilizing the equity in your home to buy luxury items. It's not the fund you should be tapping into to buy the fancy car or the boat or the camper. If you know that you're only going to spend this money on a bunch of fancy things to keep up with the Joneses, then you should absolutely not do a cash out refinance or any of the other methods that I've suggested in this video. It's not going to put you in a stronger financial situation. If you don't have the margin built up in your lifestyle to naturally save for those luxury items, then you probably don't have the margin built up in your lifestyle to pay for the additional debt burden that you're going to be incurring by accessing the equity in your home. And the final reason I don't think you should actually access the equity in your home is to upgrade your house. And I know what you're thinking, hey, isn't that the main reason most people access the equity in their home? And the answer is yes, but most home improvement items don't actually have a very strong return on investment. So if you're doing a bathroom remodel, adding a metal roof, or adding a deck to your home, these things don't actually add a ton of value to the property, and you're not going to get a very strong return on your investment. There's a handful of things that you can actually get a strong return on investment from. So if you do a minor kitchen remodel, so this is just upgrading the appliances to more efficient appliances, changing out the cabinet doors, and changing out the flooring to more resilient modern flooring. Very minor kitchen renovations that are less than about $26,000, you can expect to get your money back. But if you do a floor to ceiling, state-of-the-art, luxury, complete overhaul of your kitchen, you're probably not going to get the money out of that remodel, and it is not worth doing. So you really want to be doing high value additions to your home. So you want to be adding square footage or improving the veneer of your home so you have more curb appeal and it's a more resilient outside of your home. And I'll actually leave a link to an article down below of the top 5 home improvements that have the best return on investment.
Oh my God, that makes so much sense.
So let's go over some scenarios where I think it would actually make sense to access the equity in your house. So one of the reasons it might be worth accessing the equity in your home is if you're doing debt consolidation. So if you have very high interest rate debt from credit cards or other personal loans or other sources, it could make sense to lower your overall interest payments by consolidating all those debts from those various sources down into a single payment from the equity that you accessed in your home. And just doing this one move could help you get out of a bad situation. But if you haven't fixed the underlying behaviors that got you there in the first place, then it can be very easy to repeat that cycle. And now you have an additional debt on top of the high interest rate debt that you accumulated to begin with. So if you are struggling with these issues, you really want to talk to a nonprofit debt consolidation agency. And I will leave a link down below to the Department of Justice approved debt consolidation agency list. So you can look up an approved debt consolidation agency in your area to help you sort through your debt. So another reason you might consider actually accessing the equity in your home is if you intend to use it on an investment. So this was the reason I accessed the equity in one of my investment properties. So we were actually doing a cash out refinance on one of our investment properties. It lowered the interest rate on the payments for the property and allowed us to take out a large cash out refi that we used as a down payment on another investment property. So it was a win-win scenario where we kept the payments essentially the same, even though we accessed all that capital, and it gave us the money to buy another cash flowing asset. So if you have a solid plan in place, how you're going to use those funds to either purchase additional real estate that's going to cash flow or apply to a business that you've already established, then it could be a very strong use for accessing the equity in your home. So one big benefit to accessing the equity in your home is that that money is not taxed. This is non-taxed money. So it's a good way to defer taxes into the future. You've accessed some of the equity now and you've invested it somewhere else. And when you pay off the house, you don't have a new cost basis for the home. It's still going to be referenced to the initial price that you paid for the home, but you are able to use the equity for years or potentially even decades before you actually had to sell the home or realize those gains from the home. This tax deferral strategy is one of the strongest ways to use these tools. So there's an entire investing strategy called the BRRRR method that uses cash out refinance. So essentially you buy a house, you rehab the house to increase the value of the home, you rent it out, then you do a cash out refinance to extract the value that you've added to the home, and then you repeat this process. So that initial down payment that you put into the home, you extract at the end when you do that cash out refinance. It is a very strong tool in an investor's toolbox if it's utilized the right way. And a lot of people who have hundreds and hundreds of doors, this is the method that they use. They BRRRR from property to property and build very large portfolios. And the last way where I think it could actually make sense is if you use it as a tool in retirement. So those reverse mortgage products are a good way to supplement your retirement income. And if they are used judiciously with the help of a financial planner and a strong retirement plan, I think that can be a very good tool for enjoying your retirement and enjoying this asset that you've paid off across your working life. If you plan to utilize any of the methods that I've laid out in this video, do seek the guidance of a financial professional because everyone's situation is different. And like I said, if you are in debt and you are struggling to get out from under it, I am leaving a link down below for that Department of Justice site so you can find a nonprofit debt consolidation agency to help you sort through your finances. And if you're still on the fence about whether home ownership is for you or not, you can actually check out my video on renting versus buying, where I lay out all the different reasons why it would make sense to rent or buy, and you can draw your own conclusions about what's going to be best for you and your family. Thanks for tuning in, and I will catch you guys next time.